It's time now for the Wall Street Beat. Today we're getting the view from Bain Capital about the current global macro landscape. Trade optimism is boosting public markets. Let's see if they're boosting private ones too. Joining us at the desk, David Gross, co-managing partner of Bain Capital, a firm with approximately $185 billion in assets under management. How do things change? A lot of the public markets are reacting pretty drastically to a lot of these headlines, but a lot of the volatility has not translated on the way down as it translated on the way up for private markets.
Right. Well, I think you've seen some announcements which suggest that there are trade deals coming, and there's a balance that's being, struck between some of the policies we saw in Liberation Day and ultimately things that will be good for economic growth. I do think it's important to stay one level above from the daily announcements because there are so many of them. But directionally, I think the economy is doing, fairly well. I'd say better than we would expected coming into this year. The markets have absorbed the trade discussions and focused on pretty good labor numbers, pretty good overall numbers in the consumer sector, and now you have some government stimulus that's on the way. So I think there's some optimism, within a very multifaceted policy regime that's being developed.
Usually we ask this question for public market investors, but I've heard it now being discussed as a worry for private market investors. The dollar decline that we've seen over the past year. How much do you worry about it and have to start factoring in the threats to the dollar long term when you're making investment decisions on what to buy? Things that might be sensitive to it because of their imports or exports or for any other reason.
Sure. It's one of the factors you look at for sure. And recall, the dollar's been quite strong now and on a continuous linear upswing for many years. So in a lot of businesses that we own, we've factored in scenarios for the dollar to kind of revert to something that's more kind of long term. And we're a global operator of businesses, so we have businesses that have exposures across lots of different currencies. And so it's not just the dollar, but it's the dollar relative to what? Relative to the yen, relative to the euro. What does that mean for underlying long-term, economic growth? And I still think you've got some positives in the U.S. kind of side of the equation with strong productivity growth, strong long-term prospects that will potentially cause some dollar weakening, but within a relatively narrow band.
So the trade deals make things maybe better than expected, certainly better than expected on April 3rd. But I imagine you still have to do some shifting in terms of global supply chains. How significant has that been?
It's true, and again, I remind everyone that this is a trend that's been occurring now for 5 or 10 years. We've seen, in many ways, the breakdown of free and unfettered global trade for a lot of years, and so we've been counseling our businesses to come up with backup plans, alternatives for supply chain, in many cases to find production opportunities in the United States, to the extent it's a U.S. Kind of end market. And we've accelerated that with our business, obviously, post-Liberation Day, but it's really putting in action kind of the plan B that was there. But a lot of businesses do face significant uncertainty about where tariffs will land. We don't know if the effective tariff rate will be net 7, 10, or 15, but we do know they'll be substantially higher than the past. And so there's kind of a hedge that I think all business planners have to put into their models right now.
I don't know, you're probably going to go there, Sonali, but I'm always interested in how public investors can get a hold of private assets. We already see big retirement firms being able to do this for teachers and cops, but for me and Sonali, right, it's more difficult.
And a lot of people are waiting for that President Trump executive order for 401ks.
That's exactly where I was going, exactly my point. What do you think that's going to do for the business?
Well, listen, it's part of a longer-term trend to open up, called alternative investments, to a broader set of investors. And I think it is positive in the sense that groups that have not been able to access it due to accredited investor rules or due to just a lack of being able to get into these funds now have opportunities to balance their portfolios just like pension funds and sovereign wealth funds have in the past. And so I think it's a good long-term secular trend that you're going to see along with the penetration of alternative investments. funds. But there's some aspects of it that we're going to have to be cautious around. It's a different investor base, not as used to the illiquidity that is there. Could be potentially more volatile in downturns. And so there's some potential negatives that the industry really has to build into their thinking around how aggressively you pursue this class.
Speaking of liquidity, I want to point out a story that was this morning just in the Financial Times, the continuation fund model that has been pulling so much money, $41 billion worth of investments in the first 6 months of this year alone were gone to continuation funds. A record use of what's been a controversial tactic to cash out by selling assets to themselves or to other funds. Right. I mean, this has become, I mean, crazy at best a little bit, right? I mean, I don't really have another word for it.
To me, it's, I mean, you cover this industry and you're in it. So for you guys, this is pretty normal. For an outsider, for a layman like me, it's hilarious. You know that.
Well, let me give you the other side of the equation here, which is a structure that gives you the opportunity to hold on to really great businesses in a long-term sense is really actually a new tool for an idea that's been around for a long time in private equity. But like with any financial tool, it can be used well and misused. And the use well case is we're going to keep holding a business and invest, but also give our limited partners the opportunity to monetize if they'd like to, or to reinvest if they'd like to, and to bring in new investors, secondary funds, who are very sophisticated and will make a decision whether they would like to do it. It's misused if it's not a very good business or it's a business that's hard to sell and you're not giving that choice to investors. And I think some have gone down route A and some have gone down route B. And I think a lot of articles about the route B, but I do think this is like anything else, it's innovation. And innovation comes with some initial fits and starts to find out, how do we deploy this to the mutual benefit of all the parties involved.
And it could certainly be a double-edged sword. We'll be watching it through. I've heard this morning that like 15% of deals that we're seeing right now in this space, compared to like 5 to 8% typically, are being done through these funds. So
yeah, but to your point, they're sophisticated.
0 to 5.
They're sophisticated investors at the same time, right? So they know what they're buying. It's not like
presumably.
Yeah.
But sometimes the tide does go out. Anyways, Bain Capital co-managing partner David Groski, thank you so much for walking us through all the complexity.